The US labor market just collapsed. And I am not using that word lightly. 108,235 jobs were cut in January alone. That is a 118% increase compared to January 2025, not 10% higher. Not 20% higher, not even 50% higher, more than double. The job cuts more than doubled in a single year. And while you were being told the economy is resilient, while the mainstream media kept repeating that everything is fine, while politicians promised manufacturing booms and economic revivals, the actual data tells a completely different story, a story they do not want you to see. But it gets worse, because while job cuts are exploding, job creation has collapsed. Private companies added only 22,000 jobs in January. The expectation was 45,000. That was already a low bar. And they missed it by more than half. Let me put that in perspective for you. In 2022, the economy was creating 200,000 jobs a month, sometimes 300,000, sometimes 500,000. One month saw 800,000 jobs created, and now we are celebrating 22,000? That is not job growth. That is life support. That is an economy gasping for air while everyone pretends it is breathing normally. And here is what should really concern you. Job openings have fallen by 1 million in the last 12 months, from 7.5 million to 6.5 million. So we have fewer jobs being created, we have more jobs being cut, and we have fewer positions available for those who lost their jobs. This is not a slowdown. This is a deterioration, a systematic weakening of the foundation that holds the entire economy together. By the end of this video, you will understand exactly what is happening, why the Federal Reserve is trapped, and what this means for your money, your job, and your future. Because what comes next could define the American economy for the next decade. Welcome to the hidden economy. If you are new here, I cut through the noise and show you what is actually happening while everyone else is distracted by headlines and political theater. I do not do spin. I do not do talking points. I show you verified data from official sources so you can make informed decisions about your life and your money. Subscribe right now because this is the kind of analysis that could protect your family. And if you find value in this video, hit that like button. It helps more people see the truth. Now let me take you through the data because the numbers tell a story that words cannot capture. Today is February 7th, 2026, and this week we received 3 critical reports about the labor market, each one worse than the last, each one painting a darker picture, each one ignored by mainstream coverage. On Wednesday, the ADP National Employment Report came out. ADP tracks private sector employment. These are real companies making real hiring and firing decisions, not government estimates, not seasonal adjustments, actual payroll data from hundreds of thousands of businesses across America. The report showed that private companies added only 22,000 jobs in January. The analyst consensus was 45,000. They expected weakness and got something even weaker. ADP's chief economist said something that should send chills down your spine. Quote, "Hiring is softening. It continues a pattern that we have noticed for the past 3 years. Employers are cautious to hire in the current economy." End quote. Read that again. This is not a 1-month anomaly. This is a 3-year pattern, a slow motion collapse that has been building while everyone was looking elsewhere, a steady erosion of job creation that accelerated dramatically in the last 7 months. Let me show you what I mean. I want you to visualize the job creation numbers from 2022 through 2025 because context matters. In 2022, the economy was roaring back from the pandemic disruption. Monthly job creation was massive, 200,000 jobs, 300,000 jobs, 400,000 jobs, 500,000 jobs. 1 month hit 800,000. That was the narrative. America is back. The economy is booming. Jobs everywhere. Now look at 2025. The first few months were decent, around 100,000 jobs per month. Not great, but acceptable. And then something broke. In the last 7 months of 2025, 3 of those months saw actual job losses. Not slow growth, negative growth. The economy was destroying more jobs than it was creating. October 2025 saw 173,000 jobs lost in a single month. That is not a soft landing. That is a crash landing that the media somehow forgot to mention. And now January 2026 shows only 22,000 jobs created. We went from 800,000 to 22,000. A 97% collapse in job creation. 97%. If any other metric in your life collapsed by 97%, you would call it a catastrophe. But when it happens to the labor market, they call it softening. On Thursday, we got the Challenger report. This tracks job cuts announced by US-based employers. And the headline was brutal. Job cuts surged. Hirings fell to a record low. Let me repeat that. Hirings fell to a record low. Not a low, a record low. The lowest in the history of the report. In January 2026, US employers announced 108,435 job cuts. Compare that to January 2025 when we saw roughly 49,000 job cuts. That is a 118% increase year over year, more than double. And remember what I always tell you, when you see a number double in 1 year, that is not a trend. That is an acceleration. That is a system under stress. That is warning lights flashing red across the dashboard while the driver insists everything is fine. Now let me break down where these job cuts are coming from, because that tells you even more about what is really happening in the economy. Transportation led the way with just over 31,000 job cuts in January. Think about what that means. Transportation is the circulatory system of the economy. When transportation companies cut jobs, it means fewer goods are moving. Less demand, less economic activity. Companies do not cut transportation workers when business is booming. They cut them when there is less to transport. Technology saw approximately 22,000 job cuts. This is supposed to be the growth sector, the future of the economy, the industry that was going to create millions of high-paying jobs. Instead, it is hemorrhaging workers. The tech layoffs that started in 2023 never really stopped. They just became normalized. We stopped being shocked by them, and now they continue, month after month, while everyone pretends it is just temporary restructuring. Healthcare saw 17,000 job cuts. And this one is particularly alarming because it defies logic on the surface. The population is aging. We have more elderly people than ever before. Chronic disease rates are exploding. Demand for healthcare should be increasing. So why are hospitals cutting workers? Let me explain, because this reveals something important about how broken our system has become. Hospitals are being squeezed from both sides. On one side, costs are going up. They have to pay workers more because of inflation. They have to pay more for supplies. Equipment costs have risen. Maintenance costs have risen. Energy costs have risen. Everything costs more. On the other side, Medicare and Medicaid reimbursements have gone down. The government pays hospitals less for treating patients while expecting the same level of care. So what choice do hospitals have? Costs up, revenue down. The math does not work. So they cut jobs, they reduce staff, they stretch remaining workers thinner and thinner, and patient care suffers. People wait longer in emergency rooms. Appointments get pushed out months. Nurses handle more patients than they safely should. Errors increase. Outcomes worsen. This is not theoretical. If you have been to a hospital recently or know someone who has, you have probably seen this firsthand. The healthcare system is being hollowed out from the inside while the outside still looks functional. Now let me tell you about the reasons driving these job cuts, because this is where you see the real picture of the economy. The Challenger report breaks down why companies are cutting workers. Contract losses were the biggest driver, responsible for just under 31,000 job cuts. What does contract losses mean? It means companies that had contracts with other companies or the government lost those contracts. The work went away. That means less business activity, less demand flowing through the economy. Market and economic conditions were cited for 28,000 cuts. This is companies looking at the economy and deciding they need to get smaller, not because of one specific problem. Because the whole environment is bad, restructuring accounted for 20,000 cuts. This is corporate speak for, we need to change how we operate because what we were doing is no longer working. Business closings were responsible for just under 13,000 cuts. These are not layoffs. These are companies that stopped existing entirely. Doors closed, lights off, everyone goes home. Every single one of these reasons ties back to the same root cause: a weakening economic environment, fewer contracts because there is less business, bad market conditions because demand is falling, restructuring because old business models are not working, closings because some companies cannot survive at all. Now let me talk about something that is going to accelerate dramatically. Artificial intelligence, AI, was responsible for 7,624 job cuts in January. That is 7% of total cuts for the month. I know that might seem low, only 7%. But I am going to tell you from firsthand experience why this number is going to explode. I run a company called Clear Value Lending. We help small businesses get financing, and our company is AI powered. When you communicate with our customer service, it might seem like you are talking to a human. The responses are natural. They understand context. They answer questions appropriately. But it is not a human. It is AI. And I can tell you that the capabilities of these systems are advancing faster than most people realize. What used to require a team of 10 people can now be done by 2 people and AI. What used to require 24/7 customer service staff can now be handled by systems that never sleep, never take breaks, never call in sick. This is not science fiction. This is happening right now in companies across America, and it is going to accelerate dramatically in 2026 and 2027. The 7% you see today is going to be 15% next year, then 25%, then 40%. Entire categories of jobs are going to disappear, not slowly over decades like manufacturing jobs did, quickly, in years, maybe months. Customer service representatives, data entry clerks, basic accounting functions, administrative assistants, paralegals, junior analysts. The list goes on and on. If your job involves processing information according to rules, AI can probably do it. Maybe not perfectly, maybe not as well as the best humans, but good enough and cheap enough and fast enough and available 24/7. Companies are not going to ignore that math. They cannot afford to ignore it. Now let me show you another piece of data that confirms the deterioration. The JOLTS report, Job Openings and Labor Turnover Survey. According to the most recent data, job openings fell by 1 million over the past 12 months. 12 months ago, there were 7.5 million job openings in America. Today, there are 6.5 million. That is 1 million fewer opportunities for people looking for work. Think about what that means for someone who just lost their job. A year ago, they had 7.5 million positions they could potentially apply for. Today, 6.5 million. And tomorrow, the trend is clearly down. So we now have a situation where job creation is falling, job openings are falling, and job cuts are exploding. This is not one indicator flashing red. This is every indicator flashing red. This is the entire dashboard lit up like a Christmas tree of economic warning signs. Now, I want to hear from you because data is important, but lived experience matters too. If you are currently looking for a job, please let me know in the comments. Is the labor market as bad as these reports are making it out to be? Are you sending out resumes and hearing nothing back? Are you getting interviews but no offers? Are you seeing positions disappear before you can even apply? I genuinely want to know, because the official data can only tell part of the story. Your experience tells the rest. Now let me explain what was supposed to happen today and why it did not. The U.S. government's Bureau of Labor Statistics was supposed to release their official jobs report today, Friday, February 7th. This is the big one, the headline number that moves markets, the unemployment rate that politicians brag about or blame on their opponents. But due to the partial government shutdown, the report has been postponed until Wednesday. So we wait. But based on everything we have seen from the ADP report and the Challenger report, I can tell you what I expect. I expect the numbers to be weak, and I expect them to be revised downward later. This has become a pattern. The government releases numbers that look acceptable, markets react positively, and then weeks or months later, they quietly revise those numbers down. The headlines have already moved on. Nobody notices. The revision becomes a footnote. The consensus expectation for January job creation is 60,000. Think about that. 60,000 in an economy of 330 million people, in an economy that used to create 800,000 jobs in a single month. And even that pathetically low bar might not be met. If the ADP report is any indication, we could come in well below 60,000. We could even see negative job creation, actual job losses when the official numbers come out. Now, here is where this gets really serious. What does this mean for the Federal Reserve and interest rates? The next Federal Reserve meeting is March 18th, about 6 weeks away, and the Fed is trapped, completely trapped. They have been walking a tightrope between two disasters. On one side, inflation. It is still elevated. Prices are still too high. People are still struggling with the cost of living. The Fed's job is to get inflation down to 2%. They are not there yet. On the other side, the labor market. It is weakening. Jobs are being cut. Hiring is slowing. Unemployment is creeping up. The Fed's other job is maximum employment. They are failing at that too. These two mandates are now in direct conflict. If the Fed cuts interest rates to help the labor market, they risk reigniting inflation. Lower rates mean cheaper borrowing. Cheaper borrowing means more spending. More spending means higher prices. The inflation they spent 3 years fighting could come roaring back. If the Fed keeps interest rates high to fight inflation, they risk crushing the labor market further. High rates mean expensive borrowing. Expensive borrowing means less investment. Less investment means fewer jobs. The weakness we are seeing now could turn into a full-blown employment crisis. According to the CME FedWatch tool, there is a 77.3% chance the Federal Reserve will not cut interest rates at the March meeting, only a 22.7% chance of a cut. The market is betting they hold steady, but what if Wednesday's jobs report is terrible? What if we see negative job creation? What if unemployment ticks up significantly? Those probabilities will shift fast, and the Fed will face an impossible choice. Let me explain something about how unemployment works, because most people do not understand this, and it is critical. Unemployment does not rise slowly and steadily like a gentle wave. It accelerates. When unemployment starts going up, it tends to keep going up faster and faster. Here is why. When companies start cutting jobs, those workers stop spending money. When they stop spending money, businesses that depend on that spending see revenues drop. When revenues drop, those businesses cut jobs too. Those newly unemployed workers stop spending. More businesses suffer. More job cuts happen. It becomes a self-reinforcing cycle, an economic doom loop, a spiral that feeds on itself and accelerates until something breaks the cycle. This is not theory. This is history. Every recession follows this pattern. Small increases in unemployment lead to bigger increases. Trickles become streams. Streams become rivers. Rivers become floods. And by the time the flood arrives, it is too late to build a dam. Now let me zoom out and explain why this matters so much for the entire economy. Consumer spending makes up 70% of US GDP. 70%. 7 out of every $10 of economic activity comes from regular people buying things, not businesses investing, not government spending, regular people buying groceries, paying rent, going to restaurants, buying cars, taking vacations. If those people lose their jobs or fear losing their jobs, what do? They stop spending, they cancel the vacation, they keep the old car another year, they eat at home instead of going out, they put off buying new clothes, they delay home improvements. Every dollar they do not spend is a dollar of revenue some business does not receive. That business then has to cut costs, which means cutting jobs, which means more people stop spending. The doom loop activates, and 70% of the economy starts contracting. This is why the health of the labor market is not just about jobs. It is about everything. The labor market is the foundation. When the foundation cracks, the whole building becomes unstable. Now let me tell you something specific I'm watching in the jobs data. Manufacturing. We have been promised a manufacturing renaissance. Politicians on both sides have talked about bringing back manufacturing jobs. Reshoring, made in America, factories returning from China. It sounds great. But when I look at the data, all I see is job losses in manufacturing, month after month, report after report, more cuts than gains. Where is this manufacturing boom? I am still waiting. The factories that were supposed to be built are not being built fast enough. The jobs that were supposed to be created are not materializing. Meanwhile, existing manufacturing jobs continue to disappear. Automation takes some. Offshoring takes others. Weak demand takes the rest. If this changes, if manufacturing suddenly starts adding jobs, that would be a positive sign. That would mean the reshoring narrative is becoming reality. But so far, I do not see it in the numbers, and I am not going to pretend otherwise just because it makes for a better story. Now let me give you some perspective on what this means for different people, because not everyone is affected equally. If you have a secure job in a stable industry, you might think this does not affect you. You would be wrong. Even if you keep your job, a weakening labor market affects you. When there are more unemployed workers competing for fewer jobs, your leverage as an employee decreases. Asking for a raise becomes harder. Negotiating better benefits becomes harder. Switching to a better job becomes harder. Your employer knows you have fewer options. They act accordingly. If you are looking for a job right now, this data tells you to adjust your expectations. The market is not what it was. Positions that would have had 50 applicants now have 500. Companies that would have responded in days now take weeks or never respond at all. You may need to accept positions below what you think you deserve. You may need to consider industries you never thought about. You may need to relocate to places with better opportunities. The job search that would have taken 2 months in 2022 might take 6 months or more in 2026. If you are running a business, this data tells you to be cautious. Consumer spending is likely to weaken further. Demand for your products or services may drop. Now is not the time for aggressive expansion. Now is the time to preserve cash, reduce unnecessary expenses, prepare for a downturn that may be longer and deeper than people expect. If you are close to retirement, this data tells you to reconsider your timeline. If you lose your job at 60, finding another one will be extremely difficult in this market. Age discrimination is real even though it is illegal. Companies want younger workers who will stay longer. Your 401k might have recovered from recent volatility, but relying on getting another job if you need one is risky. Now let me address something that I think is going to become a major issue in the coming months: the disconnect between official narratives and reality. You are going to hear politicians tell you the economy is strong. You are going to see headlines about stock market gains. You are going to be told that unemployment is still historically low. All of that might be technically true while missing the bigger picture. The economy can be growing on paper while regular people are suffering. GDP can be positive while median wages stagnate. The stock market can hit new highs while job security collapses. These things can all happen at the same time because the economy is not one thing, it is millions of different experiences. And for a growing number of Americans, the experience is negative even when the headlines say otherwise. The unemployment rate you see reported is based on a specific definition. To be counted as unemployed, you must be actively looking for work. If you gave up because you could not find anything, you are not counted. If you took a part-time job because you could not find full-time work, you are not counted as unemployed. If you are underemployed, working a job far below your skill level, you are not counted. The real situation is always worse than the official number. Always. And in a weakening market like this one, the gap between official unemployment and real economic pain grows wider and wider. Now I want to share something about what I expect to happen next. Not predictions. I do not make predictions. But scenarios based on the data we have. Scenario 1. The jobs report on Wednesday comes in better than expected. Maybe 80,000 or 100,000 jobs created. Markets rally. Headlines declare the labor market is resilient. The Fed feels comfortable keeping rates high. Everyone goes back to sleep. This is possible. One data point can diverge from the trend, but it would not change the underlying deterioration we are seeing. It would just mask it for another month. Scenario 2. The jobs report confirms what ADP and Challenger are telling us. Job creation comes in below 60,000, maybe even negative. Markets panic. Headlines suddenly discover the labor market is in trouble. Pressure builds on the Fed to cut rates. They face an impossible choice with no good options. This is more likely based on the data we have, and if it happens, buckle up. Scenario 3. The jobs report is bad but not catastrophic. Maybe 40,000 jobs, enough to cause concern but not panic. The Fed does nothing at the March meeting. We drift into more uncertainty. Another month of data, another month of waiting. The slow motion deterioration continues while everyone hopes it gets better on its own. This is also likely, and in some ways it is the worst scenario because it prolongs the uncertainty. It keeps everyone in limbo. It allows the problems to compound while action is delayed. Now I want to leave you with something important, a perspective that goes beyond this month or this year. Labor markets are cyclical. They weaken and strengthen. This has happened before and will happen again. But each cycle is different. Each has its own character, its own causes, its own consequences. This cycle has some unique features that make it particularly concerning. First, AI is disrupting jobs faster than previous technology changes. The Industrial Revolution took decades to transform the labor market. AI is doing it in years. We do not have time to gradually adapt. Workers do not have time to retrain. The change is happening faster than humans can reasonably respond. Second, the debt burden is higher than ever before. Government debt, corporate debt, consumer debt, all at record levels. This limits the options for dealing with the downturn. The government cannot easily spend its way out because it is already spending massively just to pay interest on existing debt. Companies cannot easily borrow to invest because rates are high and many are already overleveraged. Consumers cannot easily borrow to maintain spending because they are already stretched thin. Third, the demographic situation is challenging. Baby boomers are retiring in huge numbers. They are leaving the workforce and consuming healthcare and social security. Fewer workers supporting more retirees. This puts additional strain on an already stressed system. Fourth, the global economic situation is fragile. China is slowing. Europe is stagnant. Supply chains are still disrupted. Geopolitical tensions are rising. The U.S. economy does not exist in isolation. Problems elsewhere become problems here. When you add all of this together, you get a picture of an economy that is vulnerable in ways it has not been before. Not just cyclically weak, but structurally challenged. Not just slowing, but potentially transforming in ways we do not fully understand. So what do you do with this information? First, protect yourself. If you have a job, do everything you can to be indispensable. Build skills that AI cannot easily replace. Be the person your company cannot afford to lose. If you are looking for a job, be aggressive and flexible. Apply to more positions. Consider industries you had not considered. Be willing to start lower than you want if it gets you in the door. Second, build resilience. Have an emergency fund, 6 months of expenses minimum, a year if you can manage it. Reduce unnecessary spending now while you have income. Pay down debt, especially high-interest debt. You do not want credit card payments crushing you if your income drops. Third, stay informed. Watch the data, not the headlines, the actual numbers, the reports I discussed today, the revisions that come later, the trends over time. Knowledge is protection. Ignorance is vulnerability. Fourth, consider alternative income streams, a side business, freelance work, rental income. Multiple income sources provide security that a single job cannot. If one stream dries up, others continue. Fifth, take care of your mental health. Economic uncertainty is stressful. Job loss is traumatic. Even the fear of job loss takes a toll. Talk to people, stay connected. Remember that your worth is not your job. Economies recover, people adapt. This too shall pass. Now let me wrap up with this. The numbers I showed you today are concerning. Job cuts doubled, job creation collapsed, job openings falling, all the indicators pointing in the wrong direction. But data without action is just information. Data with action is power. You now know what is happening. You understand the mechanics. You see what the mainstream media is not showing you. What you do with this knowledge is up to you. You can ignore it and hope everything works out. Many people will choose this path, or you can prepare. Position yourself for the storm that may be coming, not out of fear but out of prudence. The people who do best in difficult times are not those who pretended difficulty was not coming. They are those who saw it coming and prepared anyway. The jobs report comes out Wednesday. I will be watching. I will break it down for you when it arrives. Subscribe so you do not miss that analysis. And please, leave a comment telling me your experience in the labor market right now. Are you seeing what these reports describe? Is it better where you are? Is it worse? Your perspective matters because you are living this data. You are not just reading numbers on a page. You are experiencing them in your daily life. That is all for today. Hit the like button if this helped you understand what is happening. Share it with someone who needs to see this information. The more people who understand reality, the better prepared we all are. I will see you on Wednesday with the jobs report analysis. Take care of yourselves. Take care of your families. And remember, understanding is the first step to navigating whatever comes next. I am out.